Welcome to today's session on management of marketable securities. In the last session, we talked about the need for holding cash, and in the last session also we discussed like if you have a surplus cash or deficit cash, how is it to be managed? And we also discussed that the surplus cash needs to be invested into various avenues. These avenues are the marketable securities, and today we are going to discuss about this marketable securities management in this session. Now, normally, it is an overall cash management. It's a part of your overall cash management. This investment in surplus cash. Now, but why are we talking it as a? It should have been discussed in cash management, but why are we talking about it in a separate class? Because these marketable securities, they are quite a major part of the. While we are holding cash and not holding enough of cash, we talked about the consequences of that. So the surplus cash, how is it to be invested, what kind of strategy is to be formulated, what should be the optimum level of cash balance that we should be having, all these things we'll be discussing in this particular module. In fact, these securities, these surplus cash is invested in these marketable securities, which are ordinarily traded in money market and capital markets. We'll discuss more about them shortly. Now, why do we need to invest in securities? The first thing that is to do, the main reason is that there is a mismatch between the borrowing and investment program. What it means is that for example, every organization has a requirement of investing in capital expenditure projects. For example, buying of a machine, buying of a fleet of trucks, buying of new technology, and all that. But it is very difficult to arrange for money whenever I require it. Suppose I'll be requiring some amount of money next year, some amount of money in the next 3 years, some amount of money in next 5 years for capital expenditure. So it is not feasible also on the part of the organization to borrow money at the time that it is required, because that the environment, the market from which I get the funding, I do not know what kind of a scenario will it be there, whether I can raise the finance to of my requirement, for example, whether debt or equity at that point of time or not. So what companies do is they arrange for the finance and get the money beforehand. So the organizations get the debt capital or the equity capital in a single installment, in a lot, and then they keep it and they use the particular fund gradually for different purposes. So basically, the borrowing and the investment, they don't match. Like investment happens at different time periods, borrowing also happens in a different time period. So what it means that there will be a lot of idle cash. Like I have borrowed a huge amount of money, but I am going to spend it gradually. So which means there is a huge amount of unutilized fund available with the organization, and you have to pay the cost of the money has to be paid by the organization. If you keep it idle, that interest or whatever form you are paying the cost will have to be paid from the profits of the company. So that is why the companies try to do what is, instead of keeping these huge amount of cash idle, they try to minimize the loss, the cost. They want to minimize the loss on payment of the interest and all such or sort of thing by investing them in the marketable securities, so that a part of the cost is recovered from these returns from the marketable securities. So at least, for example, if for every 100 rupee you are going to pay 12 rupee as cost, let us say, even if not it is 12%, 12 rupee, some part of this cost, and if you don't invest in the marketable securities, this entire 12 rupee will be, you have to spend it from your profit. Now companies do what is, they invest this surplus fund in marketable security and recover, let us say, recover some 5-6 rupee of this 12 rupee from the marketable security, so that the loss is less. So this also depends on the investment in marketable securities also depends on the aggressiveness with which the financial manager is dealing with this kind of assets. You can categorize finance managers into, let us say, aggressive ones and the conservative ones. A middle path, maybe a moderate one. So the aggressive finance manager, he tries to manage with as less as possible amount of current asset, whereas the conservative one tries to have more of current assets, and the moderate one tries to bring a balance between these two approaches. So depending on the nature of the uh, finance manager, if he's pursuing an aggressive current asset policy, he would like to manage with less of cash, and he would pursue this investment in marketable securities very seriously. Whereas it might not be the case if we're talking about the conservative ones. Now, while we're talking about this investment in marketable securities, we have to look at three aspects. What are the three aspects? Number one, what are the market for this kind of securities? Number two, what are the assets available in each of these securities? And where I can park my fund for a very short period of time? And what are the basic nature of these kind of assets? And the third one is, what should be the optimum cash balance based on which I can convert in the lot of marketable securities into cash. So basically, how many times in a year I will liquidate my marketable securities, that or this one also has to be taken. So we'll approach them one by one. First, we'll talk about the markets for this securities. Then we'll talk about the nature, the kind of various individual assets and their nature, and then we'll talk about the optimum cash balance. Now, looking at the market for the securities, if we talk about the overall market of Indian financial market, you can categorize the Indian financial market under various headings on the various basis of categorization. Here, I have presented 4 bases of categorization. The first basis is by the nature of claim, and then the maturity of claim, then the timing of delivery, and the various kinds of structure. By the nature of claim, we can talk about the market can be divided into a debt market and an equity market. Debt is a loan market where the borrowers, with the organizations, they borrow the capital, so that because we're talking about borrowing, the organization has to repay the original principal along with some kind of interest payment. And the other section of the market would be equity market, which is basically the ownership market. Now, if you're talking about ownership, a market from which we can get the ownership capital, ownership capital is basically when you were getting funds through equity or preference, we call that a ownership capital. Now, in ownership capital, you don't pay interest and you don't repay the original amount, but what you do is you have to part with a share of your profit. So because they become owners of your company, so you have to share in your profit. Now, depending on the maturity of my claim, it could be short term or it could be long term. If it is short term, we talk about the money market. Money market is a market for short term securities. So if I'm talking about investing my funds for a short period of time, I look into money market. And if I'm looking for parking my funds for a period more than 1 year, then those kind of assets, I'll look into the capital market. Again, by time of delivery, you can have the cash market or you can have the futures market. In cash market, if you do immediate, if you want to go for immediate delivery, spot market kind of thing. In cash market, we can also call it as a spot market, where you pay for the item and you immediately receive the item. That is a cash market or the spot market. And then we have another market where it is future market. For example, you enter into an agreement today, and the actual delivery of things will happen in 3 months time or 4 months time or 6 months time, like that. So it will happen in future. The negotiation is done today, the agreement or the contract is done today, but the actual transaction happens in future. So this is another kind of a market. So when I'm talking about marketable securities, I'll be covering both the cash market as well as the future market. Then we talk about the organizational structure. In organizational structure, you can have either the OTC, the over-the-counter market, or the exchange traded market. In OTC market, it is across the counter, so there is no middleman. in this kind of a market, there is no middleman. And in case of exchange traded market, the exchange becomes the moderating party, the middle party, through which all transactions happen. So all buyers and sellers converge at one point, and that is the exchange through which all buys and sales happen. Whereas in over the counter, you have to, the buyer and seller has to come face to face, and then only the transaction can happen, because there is no middleman there in the OTC market. So the overall financial market could be categorized like depends on the basis of how we are going to categorize it. Again, if you look at the way how the borrowers approach the financial market, now see, you have the money market, and you have the capital market, we just discussed. The money market is a short-term borrowing and lending kind of a market, and the capital market is a long-term investment and capital building kind of an asset. So the borrowing institution first goes to the primary market. In the primary market, the borrower, the institution buys the asset, and if it wants to liquidate the asset, then it has to prior to the maturity, it has to go to the secondary market. So, and it can sell the asset to the other investors, and it can liquidate the asset. There are some assets which cannot be liquidated before maturity. So you have to wait till maturity and the party from which you have with whom you have transacted, the same party will liquidate your asset. There are some assets where premature liquidation can be done by selling to other investors. So it has to be negotiable in that case. So it depends on the kind of instrument you are holding. Now we talk about, as I said, that we have to talk about the various assets where we can invest our funds. Now in debt, we can categorize the various assets or securities into debt security, equity security, and the various contingent claims. Now under debt, you can have a short-term debt from the money market instrument. You can have a long-term debt from the capital market instrument. Now, debt means, as I already discussed, debt means the loan capital. Now, the point is, when we talk about the money market instrument, I'm talking about basically short term. Now, I'll just quickly brush through the various assets that are available in the money market. Number one is your call money. Now, you might be aware that of a ratio, banking ratio called CRR, which is called the cash reserve ratio. Now, every bank, in every fortnight, basically the Friday of the fortnight, the Reserve Bank requires that every bank, the CRR position is taken, and it is mandated by RBI, Reserve Bank of India, that the banks are expected to minimum balance in such a way that the CRR is maintained, the cash balance is maintained at a level of 4%. So what banks do is, just before the reporting Friday, the banks calculate the cash reserve that they have, and if there is any shortfall in the reserve, they exchange the money among themselves. And this is usually done for a very short period of time, like 2-3 days, sometimes only overnight. So the banks trade liquidity among themselves. The banks who have surplus, they give to other banks, and they get some rate of interest in lieu of that. And the banks who are having deficit, they pay a little bit of interest and get the money from the banks which are surplus. And this is for a very, very short period of time, like 3-4 days, sometimes even overnight. So this is called the call money. The money that is exchanged between banks for the maintenance of the CRR and the XLR, the statutory liquidity ratio and the cash reserve ratio. The money that exchanged between the banks is called as the call money, and the market is called the call money market. Then you have the certificate of deposit. Now, the certificate of deposit, it is an instrument that any bank or other depositories they issue to you in lieu of the funds that you have deposited with the institution or the bank. Now, this is a negotiable instrument. it is usually not redeemed before maturity, but because it is a negotiable instrument, you can, if you want liquidity before the maturity, you can sell it to another investor, and then the investor who has purchased that from you will present it before the bank, so the bank will give him the interest plus the principal back. Now usually the certificate of deposits it usually is a non-discount, it is issued at face value only, it is a non-discount asset. Then you have the commercial paper. Now, when we talk about the commercial paper, these are issued by corporates who have very, very high credit rating. So we saw that now, for example, there is a big corporate which knows that it has a surplus of, let us say, 4 lakh rupee or 5 lakh rupee, which it will not require for the next 3 months. So what can the corporate do is it can park that particular fund in commercial paper. It can issue commercial paper, sell the commercial paper, and it can sell the commercial paper, and the commercial paper who can participate in it requires corporates approach the commercial paper market when they have short-term requirement. So corporates come to the commercial paper market when they have surplus funds to park, so they sell commercial paper, and when they require fund, they sell the commercial paper, and when they need to park their fund, they buy the commercial paper from the commercial paper market. Now, even individual investors, banks, other organizations are also allowed to participate in commercial paper market, but individual investors can only buy the commercial paper, they cannot issue. Because for issuing commercial paper, there are a lot of restrictions which have to be there. So, for example, SEBI has recently revised this commercial paper market that earlier it used to be that any bank which has a net worth of 5 crore can issue commercial paper. Now it has been reduced to 4 crore, and the commercial paper denomination, each denomination is, let us say, is around 5 lakh. You can have multiples of 5 lakh also you can issue. Now the commercial paper can be issued for a very short period, for like 3 months, 4 months, usually less than 1 year, and these are issued by corporate houses to raise short-term finances. And then you have the treasury bill. Now treasury bill, as we all know, when the state governments or central governments, when they require funds to be raised from the public, they require loans, they ask the RBI for that, and RBI on behalf of the government, state government and the central government, it issues treasury bills. Now when I am buying a treasury bill, it automatically means that I am giving that amount of loan to the government. So treasury bills have the various maturities, and it can be like 81 days, 3 months. It could be 180 days, 91 days, 3 months. It could be 181 days, like 6 months. It could be 364 days. So usually it is less than 1 year. So when governments require to raise funds from the market, they go the route of treasury bill market, and that happens in the money market. Then we talk about the capital market. As we know, this is the market for the long-term securities. So the in capital market, you can have the government bonds. Treasury bill is a short term. Bonds are long term, usually more than 1 year. So you can have maturity from 1 year to 30 years. So when government requires a long term loan from the market, government can issue bonds, long term dated bonds. So that is government bond. Then the public sector undertakings can also issue bonds. Usually many of these PSU bonds, infrastructure bonds and all that, usually they come with tax concession. So if it is, then you have municipality organizations, municipalities, which are defined as local self-government in the Constitution of India. They can also raise finance through issue of bonds. You have corporate bonds, you have the companies which issue bonds. Now, the point is, The bonds are usually, if they give you a tax concession, it will be lesser interest rate. But if there is no tax concession, it could be around 13 to 18% as of today in India. Now the bonds are very, all bonds have the similar kind of feature that they come, usual face value is around is about 100 rupee in India. However, you can have 1,000 rupee bonds and various kinds of face value bonds. And the feature is the interest is known to the client. How much interest is going to get, it is known to the client. The principal is to be repaid after a certain number of years, that is also known to the client, like 5 years, 10 years, 15 years, 30 years, 25 years. So there is a repayment period of the, there is a interest rate associated, there is a repayment period. So all these things, these are the basic characteristics of bond which are similar for all these. Now depending on the kind of the party which is issuing the bond, we can have the government bond, the PSU bond, the municipal bond, the corporate bond, depends on who is issuing the bonds. These are all capital market instruments because their maturity is more than 1 year. Then we talk about the ownership assets. In ownership assets, you have the common stock and the preferred stock. The common stock, we commonly know it as a equity. So when I'm talking about equity, it gives you the right to vote, it gives you the right to control a company, but equity, there is the cash flow from the equity is not known, because the payment of dividend, if you are buying an equity, you might get the dividend. I was going to say entitled, but yes, we are not entitled to anything because the payment of dividend is discretionary. Now you can get dividend, and if you are not getting dividend, you can liquidate by selling of the stock, and the difference could be a capital gain or a capital loss. Now this is an equity. However, you get the voting right, you get the ownership, you get the controlling right. So this is about the equity capital. Now the preference is it is a hybrid between the pure debt and the pure I mean equity. So it has some of the features which are equivalent to debt, it has some of the features which are equivalent to equity. For example, when you buy a preference share, you are entitled to get dividend. So in that way it is like equity, but you are entitled to get only a fixed rate of dividend, unlike equity where the dividend rates fluctuate. The rate of dividend on the preference stock is fixed, so that way it is equivalent to the debt. And well, in preference, the debt payment, I mean the dividend payment is not it's not mandatory in the sense that if you don't want to pay this year, you can postpone this year. So in that way it is also like equity. So it's a hybrid security basically between the debt and the equity. Then we talk about the contingent claims. Now what are these contingent claims? These are the securities which give the holder to claim the whatever claim they have. The claim is on another asset. So basically these securities don't have any existence of their own, but they are piggybacking on some other asset. So the claim will come from some other asset. So these are called the contingent claims securities. Now under contingent claims, you can have futures, you can have options, you can have warrants, you can have convertibles. Now in futures, what is so mind it please, I'm not, when I'm talking about future, I'm talking about the time frame. When I'm talking about futures, I'm talking about a contingent claim security. So what is a futures? These are all contracts basically. What is a futures? Futures is a contract where we agree upon the terms and conditions of transaction today, and also decide upon the date on which the transaction will take place. So we decide the terms and conditions of transaction today, but do the actual transaction in the future period of time. Depending on the claim, I mean the contract, it could be in 90 days, could be in 60 days, could be in 6 months, like that. So what are the terms and conditions of transaction? Like what is the quantity, what is the quality of the asset that you're going to trade, what should be the price at which you are going to trade, when are you going to trade, what should be the place where you're going to trade. So all these things are decided beforehand, but the actual transaction happens in a period which is in future. So these are called the futures contract. You can have by the way, in futures contract there is a buying party and there is a selling party, and both the parties have rights as well as obligation. You have the right to buy, you have the obligation to perform as well, both the parties. Contrastingly, we have another as a contingent claim security, which is called the option. In option, you have one party has the right, whereas the other party has the obligation. So, depending on whether you have sold an option or you have purchased an option, the party who has purchased an option has the right, whereas the party which has sold the option has only the obligation, no right. So if the buyer of the option decides to exercise his right, the seller of the option has to perform. So the mechanism is developed like that. So these are option contracts, and again you have a call option and the put option. In call option you have the right to buy an asset. In put option you have the right to sell an asset. So basically you have four positions here. Now, it could be the person who is buying a call, buying a put. So technically we call that as a long call and long put. Then the person who is selling a call and selling the put, so we call them short call and short put. So there are basically four basic positions in a option market. Long call, buy a call; short call, sell a call; long put, buy a put; long short put, sell a put. So the organizations can take any of these four positions depending on whether they are surplus or they are deficit. Okay. Then we talk about the warrants. Now, what are the warrants? These warrants are like call options. Now, call options mature within 1 year, but the warrants which are issued by corporations, give the holder the right to buy the shares of this particular company at a fixed price in future. Now, the difference between so the call option also does that. But then how is a warrant different from a call option is call options mature within 1 year, whereas the warrants, they have a longer maturity. There are very few examples of a perpetual warrant also. Now, so the difference, the warrants are basically call options, but the maturity date is quite long. Okay, now we have also convertibles. Now, what are convertible securities? These are the securities which were issued as a different kind of a security, maybe like a preference share or a debenture or a bond, but they are liable to be, they can be converted into equity share in a future date. So when we are selling convertible bonds, it means that after a certain number of years, the bond will get converted into equity shares. So these are called the convertibles. Now, even preference shares are liable to be converted if they are convertible preference shares. So these are called your contingent claim securities. So these are the various kinds of securities where we can park our funds or which you can buy. To lodge your extra income, or you can sell them to raise finance from the market. We'll talk about some of these optimization models now. Now, while we are talking about optimization models, there are several models, but I'll focus my attention on the three models which are commonly used. Out of these three, the first two are dealing with certainty, whereas the last model deals with the uncertainty. So my basic assumption in the first two models, though I have not explicitly spelled it out, is that the first two, while I am using the Macadam's model and the Baumol's model, I'm basically assuming that the cash flow in the future is known with certainty, whereas when I'm talking about the Miller and Orr model, my basic assumption is that the cash flow is not known with certainty. So there is some kind of a probability attached with the cash flow. Now the point is, so we'll take up one by one. Now the Byerman and the McAdams model, it says that the basically this is a typical model which says that the investment in marketable security is only because the firms are concerned with the raising of funds. Now, some time back I told you that marketable securities, the mismatch between the investment and borrowing is there. See, you are borrowing in a chunk, but you are gradually investing from that particular chunk. So there is a amount which is remaining unutilized. Now that has a cost. Now this model has been developed to deal with the issue of raising capital. Now see, the point is the investment in marketable securities, when it is happening, I'm raising the finance from the market. So when I'm raising the finance, I need to pay some amount of money as flotation cost. So this particular cost is the essence of this particular model. Okay, now the reason for raising excess capital from the long term source is due to the high cost. Okay, and this cost needs to be optimized, that is the flotation cost needs to be optimized. Now they have given a formula how to this model. There is a formula worked out which will tell you that how this this cost of raising capital can be optimized. Will revisit this formula after we talk about a small example and we see how the trial and error method works. Now see, I'm just an example. Let us say that a farm requires 10 lakh rupee every year for the next 4 years. So this is known with certainty. As I said, this is a model which talks about the certainty. So a farm requires 10 lakh rupee every year for the next 4 years. Now the interest cost which is available in the long-term market is 14%. And the flotation cost, that is, what is the flotation cost? The cost of floating the issue. These are the costs that we pay to the bunch of people who are involved in these merchant banking activities. So that involves the cost of brokerage or processing fees and the legal fees paid to the bankers or the financial institution, the stamp duty and all sorts of things. That's the entire gamut of activities. The one cost that we call it as a flotation cost. Now the point is, the flotation cost, for the ease of understanding, we have kept it fixed that at 50,000 rupees. Now the flotation cost is a one-time cost and is not proportional to the amount raised. It is not so actually in real life. In real life, it is a percentage of the issue size. So for working out this particular problem, we have kept it at each time I'm raising 10 lakh rupee, I have to shell out an amount of 50,000 rupee as the flotation cost. That is the meaning of this particular statement. Now, it is assume that the farm raises more than 10 lakh. So now my point is, I require for the next 4 months, 1, 2, 3, 4 months, I require 10 lakh, 10 lakh, 10 lakh, 10 lakh. So that is one thing I can do. Another thing I can do is I can raise today 40 lakh and go on using that for the next 4 years. Or I can do in year 1 I raise 20 lakh and then next year I don't do anything. And the next year I raise another 20 lakh and then the next year I use the part of the 20 lakh. So there could be several things that we could do. So let us see how the cost will be affected if I choose one of these two options. I will talk about two options and how does it get it affected. In the first case, as I said, now we require 10 lakh for next 4 years. So every year, I mean in advance of course, next year I need 10 lakh doesn't mean that next year I will raise, this year I will raise. So I require now on this side of the column, I have given you the years which are the current time. 0 is the current time. Then next year, 2 years from now, 3 years from now, 4 years from now. So for the next year, I am raising the finance this year. Okay, in advance. So every year I am raising the finance, and year 4 I don't need to raise anything because there is no requirement in the 5th year. So and as I said, the flotation cost is fixed. So every year I am going to pay 50,000 rupees. I'm going to spend 50,000 rupees as the flotation cost. So this is my cash outflow. It is my expense. So every year, this year because I'm raising in advance, this year I'll pay 50,000. So and the last year there is no raising of capital, so no money. Now the I have to pay interest as we discussed in the example. There is a 14% interest. Now see, in the first year, I mean time zero today, because I'm raising the capital today. So today I don't need to pay any interest, but I have to pay the interest on the finance that I'm raising after 1 year. So here I'm paying how much? 1,40,000. Yes, 1 lakh on 10 lakh, 14% is 1,40,000 interest I'm paying. Okay, this year I'm paying 14 another 10,000 10 lakh loan is there, so I'm paying 14 lakh on this, 14 lakh on this. So my total interest is again 28 2 lakh 80,000. So third year another 10 lakh installment of loan comes, so it is 30 lakh, 14% on 30 lakh, that is 42 lakh. I mean, sorry, 4 lakh 20,000. And another installment comes, loan comes in the third year. So the total loan becomes now my 40 lakh on 40 lakh, 14%, that is the 5 lakh 60,000. This is the interest that I'm going to pay, and these are the time frames where I'm going to pay. Now, what is your total cost then? Your net cost is the flotation cost plus this particular cost. So I add up each of these costs. Now you see the net cost, it comes to, and there is no interest income. See here, there is no interest income because I require 10 lakh next year, so I raise this 10 lakh this year and then I use it the next year. So there is since there is no question of investment, there is no income here. So I have only cost, right? So I add up each of these figures and I get the cost figure in the last column. See, 50,000 plus 0, 50,000, 50,000 plus 1 lakh 40, 1 lakh 90, 50,000 plus 2 lakh 80, 3 lakh 30, 50,000 plus 4 lakh 20, 4 lakh 70, and 0 plus 5 lakh 60,000, that is 5 lakh. So this is my cost if I raise 10 lakh every year for the next 4 years. Now, let us see another option. Another option is, let us see this one, that today I raise 20 lakh and do nothing in the next year. Another, after 2 years, I raise another 20 lakh and use that 20 lakh for the next 2 years. Okay. If I do that, so ultimately I require 40 lakh. So I'm raising 20 lakh here and 20 lakh here. Okay. So what will happen now? See, if I'm raising 20 lakh here, since we said that it is not dependent on the amount of issue, we said that it is a fixed cost, so it will be 50,000 rupees. Now see, this is 50,000 rupees here. Okay, and again when we're raising in year 2, when we're raising here, it is 50,000 rupees, another cost, flotation cost. Now the point is, we'll talk about the interest. Now because here there is no interest, in year 0 there is no interest, the interest will come in the first year. Now on this 20 lakh, on that 14%, so the first year interest will be 2 lakh 80. Again, there is no, I mean, there is no issue in the, there is no loan in the third year. So I'll pay the interest on this 20 lakh here also, 2 lakh 20. Now you have another 20 lakh installment of loan. So the next years we will be paying 5 lakh 60 and 5 lakh 60 as our interest figures. Okay. Now here another interesting thing happens. This is your income column. This is your income. Sorry. This is your income from the I'm extremely sorry for this thing. Income from the right, income from the interest. Now what are we doing is, yes, this figure is your interest from the, now see, this figure is your interest. First year there is no investment. So what I am doing is I am raising 20 lakh here, okay, and I am using 10 lakh. I'm going to use 10 lakh here in the first year, so 10 lakh I'm not investing, but the remaining 10 lakh I'll be using in the year 2. So instead of keeping it idle, I invest that 10 lakh rupee for 1 year. Okay, so if I invest that 10 lakh rupee for 1 year from here to here, then I'm going to get an interest. So I am assuming that the interest rate available to me in the market is 11.5%. So which means that I invest 10 lakh for 1 year and here I get an income of 1,15,000. Again, there is the remaining 10 lakh rupees expend here. Now I am raising another loan of 20 lakh. So that year there will be no interest, but the next interest will be in income, will be in 1,15,000 in the third year. Fourth year again the entire money is consumed. So my net cash flow will be the cost minus the whatever these are the cash outflows. This is a cash inflow. So this plus this, you will have now what you will do is first the 50,000 plus 0, okay, 0 plus 2,80,000 minus 1,15,000, that is 1,65,000. Again, 50,000 plus 2,80,000 minus 0. 0 plus 5,60,000 minus 1,15,000, this figure. 0 plus 5,60,000 minus 0, this figure. Okay. So this is how it has been worked out. Now let us compare the interest, the cash outflow, basically the cash outflow that is happening in the plan 1, this plan 1 and the plan 2. So this is a comparison. Now see the net cost 50 here, here also 50. Here it is 1,90,000, here it is 1,65,000. So you have a here net savings of 25,000. Here you are spending 3,30,000, here you are spending 3,30,000, so no change. Here you are spending 4,70,000, here you have a savings of again 25,000. So a 5,60,000. So if you total it, you will see that the net cost here is 50,000 lesser. So which is the choice you are going to make? Obviously you are going to go for option 2, that is 20,000 in the beginning and another 20,000 in the 3 years time. Okay, so now we'll revisit, as I told you, we'll revisit the formula here. This is the formula. Now the formula said that we'll talk about the here the this thing, the formula, where F is your fixed flotation cost of obtaining the new finance, and D is the firm's total net outlay of cash for the next year. So when in our example, this flotation cost works out to 50,000 rupees. The F value in our case is 50,000 rupees. The D value in our case is total outlay of cash for the next period, that is our 10 lakh rupees. The I is the percentage of interest on new financing, that is 14%, and Y is the percentage of yield on the marketable security, which is 11%. So my I is 14% and my Y is 11.5%. So using this data, I can solve this problem. This is how it will look like. See, 2 into, here we have done 2 as per the formula, 2 into F into D divided by your 14% converted into decimal and 11.5% again converted into decimal. So the total figure again works out to 20 lakh. So that is the amount that you should be borrowing. We reached that to trial and error. Now through this formula also we are reaching at a figure of 20 lakh. So this is the amount that you should be borrowing in the so 20 lakh in the year 0 and when the 20 lakh in the year 3. So this is how the Baerman-Adam model work. We'll talk about the Baumol's model now. Now the Baumol's model is very equivalent to the very popular EOQ model, the economic order quantity that is used in the inventory management. It's a very popular model, and Baumol model goes by that logic. The Baumol model says that there is a cost of holding the cash and there is a cost of converting the marketable security into the cash. So that cost is called as the transaction cost. Now the firm incurs a holding cost because for keeping the cash balance. Now as we said that there is an opportunity that we are losing if we are keeping the cash balance. Okay, so that is not the holding cost, is nothing but the opportunity cost. Now, the return that we are foregoing on this particular cash that we are holding in hand is the opportunity that we are losing, and the opportunity cost, Baumol says, as per them, the opportunity cost works out to K. Is taken as K. Now, the firm's holding cost for maintaining an average cash balance works out like this. Now, if this is the cash balance we are keeping in hand, for example, if you are having a cash balance of, let us say, 2 lakh rupees, the average cash balance will be 2 lakh divided by 2, that is 1 lakh rupee. And if your opportunity cost is 10%, so 10% of this will work out to 10% of 2 lakh divided by 2, which is 10% of 1 lakh, which is nothing but 10,000 rupees. Okay, this is the holding cost. This is how they calculate. Now, there is another cost as per Baumol, that is the transaction cost. Whenever the firm, one thing is having the cash or putting the cash in marketable securities. So either you can have cash and forego the opportunity cost and the opportunity rate of return, and or put them in marketable securities and invite the burden of transaction cost, that is converting the marketable securities frequently. So whenever the firm converts the marketable securities into cash, you undertake this transaction cost. Now, the total number of transactions that you are going to do in a year can be found out by first looking at the annual requirement of cash. Suppose T is your annual requirement of cash, and divided by the cash balance, which is the C. For example, if you are annually, your annual requirement of cash is, let us say, 20 lakh, and your cash balance is going to be 2 lakh. So how many conversions you will do in a year? 20 lakh divided by 2. So that is 10 conversions we are going to do in a year. And if I say that you are going to spend 5,000 rupees per conversion, then for 10 conversions we are going to pay 5,000 into 10, that is 5 lakh rupees we are going to pay. So if the transaction cost per transaction is C, then the total transaction cost works out to C into T by C. T is my annual requirement of cash and C is my cash balance. So just now we saw that if my annual requirement of cash is, let me draw here, if my annual requirement of cash is, let us say, 20 lakh, and my cash balance is 2 lakh, so how many times I'll transact in a year? I'll transact 10 times in a year. Now, if my cost of transaction is 5,000 rupees per transaction, this is 5,000. So that I am going to spend about 5 lakh rupee in converting the items. Okay, so 5,000 rupees is a bit higher, on the higher side. So now the point is, these are the two costs. The Baumol model talks about two costs. One is a holding cost, the other one is a transaction cost. So the total cost is of this maintaining the optimum cash balance. Total cost is the holding cost plus the this transaction cost. Now the point is, this model looks very familiar to the EOQ model. The optimum cash balance, which is designated as C star here. Now the C star can be obtained by a formula here. We can do iteration models and we can do trial and error, but will save us the bother of doing that, and we'll go by the formula. Now C star, which is the optimum level of cash balance, can be computed by this formula, which is 2 into C. This is a small c, this is a capital C. Please don't confuse between the two. The small c here, this is the just now we saw what is that? That is the transaction cost per transaction, and T is my annual cash requirement and K is my opportunity cost. Now, given armed with this formula, let us see how an example how it works out. Now, suppose we have estimated that the cash requirement of a particular farm is 2 crore next year. Now, the company's opportunity cost of fund. Now, let me just write down what is the data available here for our purpose. Let me just write down here. The data given here is, let us say, the total cash requirement is given as 2 crore. And the company's opportunity cost of fund, which is K, is also given here, 15%. And the company will have to incur rupees 150 per transaction. C is given also as 150. Now, when it converts its short-term securities to cash, now determine the optimum cash balance. Now, my formula said that C star is equal to 2CT divided by K square root of that. So I plug in all the values that were given here, and we can compute. What is C? C is 150. What is the value of T here? T is 2 crore. 2 crore. So I'll put 7 zeros. I'm sorry, I'm not able to write it with this pen. Divided by, sorry, I'm sorry, not divided by 0.15. Then put a square root. So I'll not go into the algebra of this calculation. So this is how you can solve. So you get the optimum cash balance. Okay. Now, what is the total? The third question. Now let us see what is the we need to actually calculate. Otherwise, it will be difficult for us to. Let us assume that the this works out to, let us say. Let us say it works up to 4 lakh. Okay, so how many transactions will have to be made? Now it will be T by C. What is T? That is 2 crore by 4 lakh, whatever is the amount. See, please keep it in mind that this is a hypothetical figure. I have not actually calculated the figure. I'm just using 4 lakh. So probably for 2 crore by 4 lakh, there's a number of transactions you have to do. Then what is the total cost? You can use this formula for computing the total cost. Okay, so that is about how you can maintain the optimal cash balance using the Baumol's model. Okay, now we'll talk about the Miller and Orr model. As I told you in the beginning, that the Miller and Orr model is a very special model where the model talks about the cash flow which is not known with certainty. So when a cash flow is not known with certainty, we know that it's going to be difficult to actually talk about how much of cash balance to be maintained and how much to be invested in marketable securities and when to be converted. So the basic essence of this model is dealing with uncertainty. Now the Miller and Orr model provides, it says about, since we don't know about in uncertainty, so what we do is we talk about the upper limit and the lower limit. And also there is a point where we'll designate that as the return point, where if the cash balance hits that. Now I'll show you in a graph. Now see, this is the graph. We have a, see here, this is the upper limit and this is the lower limit. Okay, so you have the upper limit here and the lower limit here. Now suppose we start with hypothetically, let us say we start with the upper limit. Okay, we'll start here at the upper limit, and then once we hit, now suppose this is the suppose no, we'll not start with the upper limit, rather let us start with the lower limit. Now once my cash reaches the point of this point, what I'll do is I'll convert some of this in. I'll sell some of these securities to get cash, so that I come to the return point. So my job, my optimum cash balance is the return point. Okay, I'm going to maintain my optimum cash balance as the return at the return point. This is my optimum cash balance. Now, when I suppose my optimum cash balance is, let's say 5 lakh rupees, 50,000 rupees. Now this is the return point, which is the 50,000 rupees. And the point is, I go on accumulating. More amount of the firm's cash flow will fluctuate randomly, and the cash inflow, cash outflow will be there, so it will fluctuate randomly. And when the moment it hits the upper limit, I am going to do what is, I buy sufficient marketable securities. That means suppose I have my return point is 50,000, and my upper limit is, let us say, 2 lakh. So I will not do anything until my cash balance reaches 2 lakh. So the moment it reaches 2 lakh, I'll buy marketable securities to the tune of 1.5 lakh, so that my return point, my optimum cash balance is again maintained at 50,000 rupees. So 1 lakh and 50,000 rupees will be parked in marketable securities. Okay. Similarly, when the firm's cash flow wander and hit the lower limit, so and we have so my action points are 2 lakh, and let us say the lower limit is, let us say, 10,000 rupees. So once it hits the lower limit, I'll sell some of the marketable securities and realize the cash and come to this point. So this is my optimum cash balance, but my action points are this limit and this limit. Okay, so the moment it hits this limit, I will purchase securities and reduce my cash balance, and the moment it hits this level, I'll sell some of the securities and come to. So my target is to stay here. Okay, but it's not that since I don't know about my cash flows, I'll allow the cash to travel between the upper limit and the lower limit. Only when it hits the upper limit, I'll take action, or it hits the lower limit, then only I'll take action. Okay, and this has a complicated solution. That is the difference between, now what does the Miller and Orr model says? The difference between the upper limit and the lower limit depends on several factors. What are the factors? Number one, the transaction cost, which is designated as C, the interest rate designated as I, the standard deviation designated as the sigma, Greek letter sigma, standard deviation of the net cash flows, of the daily cash flows. Now the formula that has been used to determine the distance between the upper and lower limit, which normally we call that as Z. The upper and lower limit, the gap is called as the Z, is this one. That is, Z is equal to 3/4 of the transaction of the total, the multiplication of the transaction cost into the variance of the cash flow divided by the interest rate per day and cube root of that. Okay. And how do we determine the upper limit? This is the gap. So the upper limit is the lower limit plus 3Z. Return point is a lower limit plus the Z. And the net effect is that the firm holds the average of the cash balance equal to the lower limit plus 4/3 of the Z. So this is how we talk about the Miller and Orr model. I have a very small example. The management of now see it anticipates that 15 lakh in cash outlay will be there. The recent experience has been that it cost ₹30 to convert the marketable securities to cash and vice versa. The marketable securities currently earn 8%, which is your I. The variance or the sigma here is the daily net cash flow variance is 27,000. And the cash balance as per the Miller and Orr model, if the minimum cash balance required L is, let us say, your this 50,000. So you calculate the Z value with this. Now you have the transaction cost given to you, that is how much? 30 rupees. Then you have the cash flow variance, that is the 27,000 rupees. You plug in these values and the interest rate given here, that is the 8%. You plug in these values into this equation and solve it. Then you compute the upper limit. The lower limit is given here, 50,000. Then they calculate the upper limit, the return point from that. So these are the kinds of models that are in vogue to manage the marketable securities. So, and how to maintain the optimum cash balance. So we basically talked about the markets where you can park your funds, or where you can get the funds from for the marketable securities. Then we talked about the various assets which you can use as vehicles for parking your funds. And then we talked about the number of times you can convert your you should be able to convert your marketable securities into cash and the cost benefit analysis thereof. At the end of this discussion, you should be thorough with the you should be able to develop the strategy for managing these marketable securities. So the strategies will obviously involve these three things. You have to understand the behavior of firm's cash flow, whether you are dealing with stable cash flow, which you can predict in advance, or you are dealing with random cash flow, which is very difficult to be predicted. So that will tell you a lot about the kind of model you're going to use for your deciding the optimum cash balance. Then again, what kind of a risk you are going to take while you are going to invest in marketable securities? Because you see, depending on whether you're going for choosing the equity or choosing the debt, that will decide the kind of, if you are going for, if you are conservative, go for debt. If you are quite risk taking, you should go for the equity. So, and again, you have to develop a system where you can continuously monitor these activities, and the reporting system should be developed for continuously reporting and improving and analyzing the marketable securities and the cost benefit analysis thereof, so that you settle at the minimum cost of managing these marketable securities. So, this is all for this session's discussion. Thank you. This can.